Good morning and welcome to today's webinar. I trust you're all keeping safe and healthy. Thanks very much for taking time out of your morning to join us for this discussion. So COVID-19 took the world completely by surprise. For business big and small, the pandemic has severely impacted on its lifeblood, namely cash flow. For South African SMEs, the impact has been particularly severe. Suppliers to large businesses are facing severe sustainability challenges. And this is important, when you consider that it's estimated that more than 98% of businesses in South Africa are classified as SMEs, and analysts are now predicting that around 60% of SMEs may close before this crisis is over. So apart from devastating the South African economy, this will inevitably impact on corporate supply chains quite severely unless measures are put in place to support SMEs through this crisis. So as big business, we have a collective responsibility to work towards shaping the world of business in a more sustainable way. And a good place to start would be improved cash flow for SMEs, and particularly our SME suppliers. So today we're exploring invoice factoring, also known as factoring or debt factoring, invoice financing, as a form of alternate business funding. By creating opportunities to increase working capital and cash flow, invoice factoring can play a critical role in building greater sustainability both during as well as post this crisis. But, let's be honest, I think a few of us have been around the block a couple of times, and invoice factoring is nothing new to us. And there have been challenges with the traditional manner in which invoice factoring was typically done, resulting in it becoming an extremely expensive and somewhat unattractive form of trade finance. Accelerate Cape Town has recently acquired a sub-license for an innovative electronic invoice validation system, currently hosted by Bankser. And just to note, this system will be available at no cost to all Accelerate Cape Town members, but we do need your support to help us run some pilots and get it set up for your specific requirements. So please do reach out and let us know if you'd like to take that conversation further. So the intention of this webinar today is to explore the concept of invoice financing and to unpack a couple of key concepts. I think first up, what is invoice financing? So let's make sure we get everybody onto the same page and we all have a common understanding of invoice financing. How does it compare to other forms of credit? What are the benefits and costs of invoice financing? And then I think the bulk of today's discussion is really taking a look at digital solutions to traditional invoice financing, namely Payment Accelerator or the system that we've acquired the sub-license for. How is risk addressed through this technology, and can a third-party platform introduce efficiency into the financing process? I think also a key outcome for today's session is to potentially identify some companies that may want to participate in the pilot, and that would be both from a buyer perspective or financier perspective. The usual housekeeping notes, we'd love this to be as interactive as possible, so please do use the chat and the Q&A functionality to share some of your thoughts or reach out with questions. It will be recorded as always and available on YouTube. And please do indicate if you'd like to set up a one-on-one between your company and the Payment Accelerator team. You can send me an email directly or contact anyone in the Accelerate Cape Town team, and we'll certainly set that up for you and support you as far as possible. Okay, so let's get started. We have a great discussion today, starting off with Daniel Holland, who's the COO at Payment Accelerator. And we're going to follow that with a panel discussion where we'll be joined by both a buyer from City Logistics, Ryan Gaines, as well as a financier from Merchant Factors, Mr. Dion Teron. And I think we'll unpack the concept a little bit further and try and understand the benefits of a system like this, both from a buyer perspective, financier perspective, and of course, hopefully by the end of it, the benefits to the suppliers would be fairly evident. Okay, so kicking off, we've got Daniel. As I mentioned, he's the CEO of Payment Accelerator. Daniel has provided bespoke IT solutions to government, tertiary institutions, and the private sector for a number of years. He was part of the team that was commissioned to rebuild the Payment Accelerator platform in 2012. And was subsequently seconded to Payment Accelerator in 2016 from the agency where he had previously worked as managing director. In unison with a system developer, Daniel has been central to the evolution of the platform in the last 5 years, working closely with all stakeholders. And just on that note, a very warm welcome to the system inventor, Mr. Neville Kadachi, who's joining us this morning and is watching on. So warm welcome to you, Neville, and thank you for everything you've done to get it to this stage. Neville has served a lifetime in the invoice factoring space and spent the last decade developing the solution based on his vast experience and unique insights. And I think it's well set up for us to now reap the benefits of that labor of love. Okay, so on that note, Daniel, welcome. Good morning. Over to you.
Good morning, Ryan. Thank you for the introduction and good morning to the viewers. So what is Payment Accelerator? Payment Accelerator is a locally invented and developed fintech platform that is built on patented technology. It provides buyers, suppliers, and funders with a supply chain finance solution that relies on virtual electronic promissory notes. These are digital assets that the platform creates to enable funders to transfer the risk of payment from the SME supplier to the creditworthy buyer. The underlying transactions aren't loans or any form of credit. Instead, it's a buy and sell transaction, and this means that the transactions aren't recorded as debt, and that has a host of benefits for the SME. The platform provides an efficient paperless solution for what is currently a very manual process, and it does so in an environment where parties can trust what is presented to them, free of the typical risks in invoice financing. These efficiencies and the security of the promissory note enables the lowering of the barrier to entry for businesses and creates a new market for both funders and SMEs. And these are often businesses that are previously disadvantaged. The platform is open and focuses on providing our unique tech to businesses of all sizes. Our technology has been in development for many years and leverages over half a century's worth of experience in invoice finance. The platform itself reduces many of the risks to buyers and financiers when looking at these offerings, and integration is simple, quick, with us doing most of the legwork. Because of the integration though, suppliers are able to receive up to 80% of their validated invoice amounts, usually within 24 hours of validation, with the balance being paid over on terms. Most importantly, our platform is hosted by BankServe Africa. Now they provide the banking infrastructure across South Africa and are owned by the major banks. So why do businesses need this platform? What are the problems that it solves? Well, the buyer is typically a large corporate with many competing objectives. They need to prioritize their working capital requirements, and that often conflicts with the need to maintain a sustainable supply chain. CFOs and financial managers are pressured to maximize the return on cash on hand, and that typically materializes in extending the DPOs or payment terms. Now, this makes business and financial sense, but it can come with the unintended consequence of destabilizing the smaller suppliers who tend to be SMEs and cannot handle the extended terms. So it's quite the balancing act. We're all familiar with the issues that SMEs face. I think we know them. It's been publicized across all of the different news outlets and business publications, but ultimately it boils down to funding. Funding for growth, funding for bringing on clients, bringing new product lines, and hiring more staff, increasing capacity. This is often done through working capital, and that in itself is risky for the SME. If you tie up a lot of your funds to meet some of the requirements placed on you by one of your clients, it means that you may not have cash on hand to fulfill orders. And with their inability to get simple things like an overdraft a lot of the time, these SMEs have to look at alternative forms of funding. Now, debtor finance tends to be the safest, but it can be prohibitive. Prohibitive in that it requires a high minimum book value, or that the costs can be very high simply because of the work involved on the funder's part to ensure that they are funding legitimate transactions. And it's not easy for funders too. Funders in all forms and sizes have barriers to entry for making deals with SMEs. They have credit committees, regulatory issues, audit teams, and compliance concerns. So when a funder looks at the opportunities in the market, they look for the safest opportunity with the highest returns that will work within their operating constraints. And small debtor books can be very unappealing to funders, particularly when you consider the amount of work that goes into verifying a single transaction. Funders need to ensure that they are not being taken for a ride, while balancing that need against the cost of verifying every piece of information presented to them. Now, this is particularly relevant when you look at SMEs' access to finance. More often than not, the case is not the funder's willingness to transact with the SME, but rather the SME's inability to meet the requirements placed on them. So striking a balance between fraud prevention, risk aversion, compliance, and the desire to access new markets can be very tricky for a funder. So let's summarize. Buyers need to protect their working capital, enhance their cash flow, and protect their supply chain stability. Suppliers need access to affordable funding that will assist them in their growth and help them address a lot of the compliance challenges. Funders, on the other hand, need to provide a return on their capital with as little risk as possible, and to fund smaller books, they need to do so at a minimal cost. So how does Payment Accelerator address these issues? Well, we ensure that the buyer can optimize their supply chain efficiently without interrupting their existing processes or adding new systems that they have to operate. We allow the SME to leverage their buyer's creditworthiness and credibility to ensure that they can have access to funding at rates similar to what the buyer would get. We also provide funders the much needed security and verification of information from a trusted source, the buyer. All of this is leveraging the highly scalable nature of our platform to provide a service to businesses of all sizes at a flat rate regardless of the size of the deal. And this in effect creates an open market where everyone can participate, from corporates to SMEs, large commercial banks, and bespoke funding companies. There's room for everyone. So how does it work? Well, the normal procurement process is uninterrupted. The buyer will issue a purchase order to its vendor. That vendor, the SME, will then fulfill that order and deliver the goods or perform the service. The buyer would verify the delivery or check the service has been fulfilled to their requirements, and at that point the supplier will then issue them with an invoice. The buyer will then compare the invoice to the purchase order and their receipting documents to verify that this invoice is due and payable. And that's the typical process. When the buyer issues a purchase order, that is automatically extracted by our integration and submitted through to the platform. The same goes for all of the receipting data. When the buyer confirms the invoice is due and payable and posted to the relevant ledgers, that's extracted, and then our platform's validation engine processes the invoice and makes it available for funding. It's at this point that the supplier will log in, look at the invoices that have been validated, and select either all of them or a combination of them according to their needs to create an offer. And that offer is automatically sent through to their funder, who then reviews the information, looks at their own internal processes to ensure that they can extend funding, and then they do so typically at 70 to 80% of the total value of the offer. They withhold a certain portion and pay that out on the due date. And this is to protect against the normal likelihood of manufacturing defect and returns. These are inherent in business and no platform can prevent that. When the invoices are due, the buyer pays the financier, and the financier releases the balance of this offer less their fees to the supplier. So let's look at the benefits for each party a little bit more closely. The value proposition of supply chain finance to a buyer is not new. We've all had some exposure to it, and the general sales pitch is increase your DPOs with supply chain finance. And this is absolutely a benefit to the buyer. It's always an option, but in light of this discussion and the drive for sustainability, we do encourage buyers not to extend terms where it wasn't already part of their strategy. The use of the platform does have an effect on the buyer's supply chain stability because you allow the suppliers to leverage your credit worthiness to get rates that are comparable to yours and rates that they would typically never get access to, and that allows them to fund their receivables and improve their position. The platform comes at no direct or upfront cost to the buyer, and the integration process is managed by our team. When the supplier has access to funding and at low rates, the buyer has the peace of mind that the supplier will be able to fund future orders without any interruption to their existing processes. SMEs enjoy a host of benefits too. With access to finance being such a hot topic, our platform makes this a reality by allowing the SME to leverage their client's creditworthiness. When an SME needs cash, if they qualify for a credit facility, they're happy to take what's offered. We've heard stories of personal loans, overdraft, and even loan shark deals being used to fund businesses. And leveraging the buyer's creditworthiness against invoices means that the SME can get funding at rates similar to that of the buyers. These lower funding costs help the SME to get greater profit margins and having cash up front allows them to seek settlement discounts with their supply chain and perform the same level of optimization that the buyers tend to do. This, coupled with having access to funding that isn't credit, helps the SME when they actually need credit. And we're talking about asset finance and any sort of credit that would help expand the business. So this is a huge benefit to the SMEs. But the funders get benefits too. Due to the buyer's integration and the issuing of the virtual electronic promissory note, funders can focus on the deal without the overhanging risks of fraud and collusion that are prevalent in the industry. Funders can optimize their internal resources, reducing the number of people confirming and verifying invoices, and focus those efforts on onboarding and client technical support. When automation is introduced, funders can explore new avenues of business, tapping into underserviced markets and using technology to lower the cost of doing business while taking on businesses who are destined for growth. So let's look at the bigger picture, and that is SME sustainability. SMEs are vital to our economy. They contribute upwards of 50% of the gross domestic product and employ more than 60% of the workforce. You don't have to be an economist to see how helping SMEs will ensure a national benefit. So allowing an SME to leverage their buyer's creditworthiness to get lower rates and not have to put collateral up front will be a massive benefit to the SME. The implementation of the platform comes at no cost and can be rolled out to suppliers of all sizes. And the reduced risk that the platform creates helps banks and funders take on smaller, less established businesses. The buyer, by contributing and being part of this process, is assisting the upliftment of these SMEs. This program comes at no cost to the buyer and no upfront cost to the supplier. So why Payment Accelerator? Well, our patented system transmits supplier invoices from the buyers, validates them, and makes them accessible to funders in the form of virtual electronic promissory notes. We own our own technology, and integration is the core of our platform. We offer end-to-end integration support, and our system bolts on easily to all major accounting software. Quick setup times mean that your day-to-day operations aren't affected, and our integration tools speed up the integration process, requiring minimal effort on the buyer and funder's part. Our diverse and versatile team has a wealth of experience, from ex-board members of the Reserve Bank to business magnates and seasoned software architects. The efficiencies that are introduced through all of the automation that happens on the platform, the virtual electronic promissory notes that are created, and the underlying security that comes as a result of that, means that every step in the funding process is made as efficient as possible. And we're really passionate about improving the economic climate in South Africa. We believe strongly that our platform is going to make a marked change in business in South Africa. And we challenge buyers and funders to participate to help the smaller SMEs. Thank you, Ryan. Over to you.
But it was a great presentation, and thanks for that overview. I think it would be great to take a deeper dive into it, and I think we've got a great panel today, and both a buyer and a financier to provide their perspectives. And so from the buyer's perspective, we're fortunate to be joined by Ryan Gaines, the CEO of City Logistics, who's been using the system for a while. Gaines has been part of the City Logistics team for over 13 years, commencing as financial manager before being promoted to financial director and then managing director. During that time, he's directed considerable company growth while being responsible for much change and transition. Morning, Ryan. Thanks for joining us. And then also joining us on the panel this morning is Dion Teron. Dion Teron is the National Commercial and Marketing Manager at Merchant Factors. He's going to provide the financier's perspective for us this morning. He's an alumnus of Stellenbosch University and passionate about helping companies grow. He's been assisting business to succeed their potential for more than 23 years. And Merchant Factors, of course, was founded as far back as 1988 and are today leaders in factoring and trade finance. So welcome, Dion, and thanks for joining us as well. And Daniel, if you could come back and join us as well, I think that would be fantastic. So thanks for joining us, guys. I'm quite keen to take a little bit of a deeper dive into the system. I mean, it sounds great when Daniel presents it, but obviously he might be slightly biased. Ryan, maybe let's start with the buyer's perspective. As City Logistics, for you, what is the importance and benefits of invoice factoring from your perspective, and how does that help your suppliers?
Yeah, so I think over the last 10, 15 years, there's been a significant growth in our business, and to allow our suppliers to kind of keep up with our growth, particularly the SMEs. We've looked at alternate methods of paying them. In some instances, we provide fuel, particularly for our transport suppliers, because fuel's generally a cash item, and it's something they kind of need in advance. Because you don't get credit terms on fuel. So Payment Accelerator appeared to be a kind of a solution where we could support them, but still not necessarily be engaged in the process directly. So it wouldn't affect our internal working capital and affect our growth. Our experience as a buyer was that we implemented Payment Accelerator. We ran SAP. And the Payment Accelerator team, in a very short space of time, managed to integrate into our accounting system with restricted access, only accessing sort of the suppliers who we had signed up for the process. We allowed the suppliers to make individual decisions. The main suppliers in our business that have used Payment Accelerator are the transportation suppliers. So particularly on the long distance side, where the cash outlay up front for capital equipment is high, and then also some of our labor suppliers, so our subcontracted labor suppliers. And it gives the financier the sort of the visibility. It also, and we've been in discussions with Payment Accelerator about the benefits to us in terms of supply reporting, because one thing that we did have sight of was sort of as suppliers potentially are struggling. They kind of start asking for payment earlier. Payment Accelerator can give us that kind of insight as to whether they were typically discounting invoices in the latter part of the month just before payment, and now they've started having to discount them earlier, which may indicate sort of supply chain risk for us on our supply base. And I guess it also allows us to engage with a broader base of suppliers, because in the instance that some of the smaller suppliers are not well capitalized, they can grow their businesses because they've now got working capital finance that's available to them. Although the margins in transport are tight, the ability to ratchet their businesses up. If they put 4 trucks and they now add 2 or 3 trucks, they've grown 50%. For them to fund that kind of growth is very difficult without some form of working capital finance. And it's typically asset finance in that environment is quite easy to obtain from a bank. Working capital finance for those type of SMEs is very difficult to obtain. So it's been very good for our lead strategy and our working capital management.
Thanks to CV90, one of the biggest trends that we're noticing is, obviously because of the disruption to supply chain, a lot of companies are going to be looking to develop local suppliers and to possibly replace some of those imports. And a system like this obviously then assists massively, as you've mentioned, in developing those suppliers and giving them another access to working finance. So thanks for that insight. Maybe just changing lanes a little bit to the financier perspective. Dion, from your perspective as a financier, you've been in this game for quite a while. What are your sort of typical clients? What are the importance of invoice factoring for them, and how does it benefit their businesses?
Morning, Ryan. Yeah, the typical invoice client is probably a normal business, like Daniel said, million rand turnover and upwards. Obviously, we place a lot of emphasis on your debtors profile, the quality of debtors, because ultimately that is your source of repayment. Typical client is a client that are undercapitalized, lack of funding, growing through the funding resources via shareholders, directors, shareholders funding, or via commercial bank funding, not keeping in line with growth. And obviously that growth puts a constraint on the cash flow and ability to prosper. Like Ryan correctly said, CapEx, all the expenditure, money started up in working capital, does leave a lot of SMEs now a bit over a barrel. And conventional factoring, or if I say conventional factoring, as we apply it, we as merchant factors and other institutions out there, as it enables the business to free up working capital, which in turn should help them to grow. They can extend the terms to their customer base in order to sustain the turnover. Paying the suppliers, again, as emphasized by Daniel, paying the suppliers up front, negotiating discounts. So the factoring instrument, or invoice discounting instrument, does play a role in terms of funding of SMEs. It's the quickest way to access cash. It's not construed a form of lending, so there's no gearing ratios applied to it. We're buying an asset. Somebody that I'm advancing your money against the invoice that we have purchased via whether it's a factoring agreement or outright cession of debtors. So yeah, the typical client would be manufacturing and service industry. Transport we also do, and we understand that transport has got their own nuances and other things applied with from your tire suppliers right throughout. Everybody wants their terms, everybody wants their piece of cake, but you got to keep a business going. So yeah.
And challenges that you guys experience as a financier in that space?
The challenges we face is, I mean, you can think for yourself that the amount of invoices. Now again, getting back to the transport industry, the invoice is one document, but if you look at the transport industry, the underlying documents, the delivery note, the load confirmation, the waybill certificate, all the underlying documents, those must all be validated. So firstly, you got a labor component that's being tied up. You got a client on the other hand that's demanding money. But you can only release money once those invoices have been physically, with human intervention, been validated. So the opportunity for fraud, you can think for yourself, is anybody can sign a delivery note. How do we know that ownership and risk has transferred? How do we prove that in a court of law? So the challenge has always been the risk factor. The labor element of how much resources are being applied. Again, like Daniel said, economies of scale. How many labor resources are you applying to a customer in order to get the same exercise? And also the interaction between the financier, the supplier, and the buyer. We're not there to destroy the goodwill and nor impose any detriment upon the relationship. So if you got the financier, well, the client wants money, I need to validate. Yeah, so that's why this is all alleviated by Payment Accelerator.
Fantastic. Thanks for that. And so in your view, Payment Accelerator has really alleviated a lot of the key challenges from a financier's perspective. Yeah. And maybe, Ryan, from your perspective as a buyer, has Payment Accelerator assisted at all in addressing some of the key challenges you've experienced?
Yeah, so I think from a buyer's perspective, the ability to extend it to multiple suppliers, sort of at your instance, is valuable. So the take-on process is quite slick, and the way that it gets extended to other suppliers is quite simple. So I think the key issue that we considered internally was the confidentiality of internal accounting documents. So I mean, there was some work to do on that just to make sure that our accounting documents with the third-party software coming in where there was confidentiality around that. But once we are over that hurdle, I mean, the reality is now, if we go on a tender to a broader base of transporters, our ability to support those transporters' commercial offering, and to get an improved commercial offering by giving them the option of funding, not by ourselves but by a third party, as part of the way that they could support us. We then targeting operational competence, not financial competence, which really is what we're looking for from our supply base. So yeah, I think that's really the benefit from the buyer's perspective. I know, in having chatted to Daniel, that there is quite a bit of work being done on the buyer's side to kind of create additional value to the buyer. So maybe he will talk to that, because I'm not as close to that side of it. But yeah, there's definitely opportunities around supplier reporting, which we have canvassed in some of our discussions.
Cool. Thanks. That's a nice segue to bring Daniel back into the discussion, I think. But something that is coming across quite strongly for me is the extent to which the supplier is empowered throughout this process. And it's not sort of a financing product that's being forced onto them, but it gives them complete control as to what invoices they would like to have financed and so on. Daniel, any additional thoughts in terms of benefits to buyers?
Yeah, so we have a new suite of functionality that we're launching in the coming month. We've got a very strict deadline with the dev team. It's just obviously finishing off testing and picking up the last few bits of gremlins. But effectively, what we're doing in our automated onboarding process is allowing the buyer to pass on some of their supplier compliance requirements to us. So as the buyer needs to keep track of, for example, BEE certificates, tax clearance, whatever the case may be, the buyer can request that we obtain this as part of the supplier's sign-up process with us. And we effectively get that information from the supplier, pass it on to the buyer, but ensure that the information presented to us is as it should be. You're not just uploading a blank document and saying, that's my tax clearance. And the registration process goes through a review series with our system that ensures that that information is validated and then passed on to the buyer, who then can handle and hand off that responsibility. Similarly, that functionality is also extended across to the funders. Now, the funders have a lot of regulatory constraints and legislated to, for example, know your client. KYC is a big issue for banks, and our system does what we call a soft KYC, and we obtain that information for the funder in the registration process. So when the funder has this particular supplier brought to them, they have the information there. We're obviously not verifying the validity of that information. The funder has got much better processes and systems in place to ensure that the ID is valid, that the company certificate is valid. But what we're doing is taking the pain point of getting that information from the supplier after the fact, instead getting it in the registration process when the supplier is going to be expecting to do something. So we're trying to streamline that process as well.
Cool. I see a question has just come through from one of the audience members. Thanks, Mariam Dietrich, for that question. And she's sort of asking, is there any risk to contractors? And do you have any perspectives on the risk to contractors, and specifically in the construction industry?
So I think Dion can answer this a lot better than I will, but just to preempt that, I can imagine in the contracting environment, it's a much longer supply process. You know, the contractor is coming in, they've got goods, they have to then assemble those goods in various forms, and it's not as straightforward as, for example, delivering a finished product, because there's a sign-off that needs to happen, and that the inspection and approval of the finished product can be an iterative process. You know, everyone has a story about a contractor not doing things as they expected, and often it's a communication issue, not necessarily an ability issue, but there's this, I expected this window frame to be like this, and it's like that. And that in itself can hold up the validation process. So I think there are some industries where we're not saying this is a silver bullet, and there are some industries where it won't really apply. But I'm not going to rule out contractors. I think Dion, being the funder, he can answer that specifically.
No, thanks, Daniel. Mario, yeah, good question. Contracts, construction, fabrication, whichever terminology you want to apply, normally falls outside of the sphere of a factoring environment, simply because of the fact that you've got an invoice for something that you have done or delivered up to a certain point. That work is not complete. The risk the financier runs is, whilst you raise the invoice for services product rendered to a certain stage, if you are not there to continue the project, i.e. there's a future performance and an underlying risk that you as contractor must perform, that will invalidate the validity of the repayment of that invoice. And your customer has got within rights to raise a counterclaim or apply a potential penalty via the damages, etc. So that's why it normally falls outside of the environment. to answer the question.
Thanks for that. Another question from Mike. And Mike, this is specifically directed to you, Dion, and he wants to know if you think that supply chain finance will eventually replace invoice discounting and factoring.
Okay, the need for working capital will never go away, especially now more than ever. Okay, SMEs, businesses are not born corporate, so to raise working capital will never go away. So let's just park it there. Factoring or invoice discounting, whether it's going to be done strictly be a human intervention, i.e. the way we still do it, or digitally on the platform, I think the need will always be there. As long as you got business to business engaging with one another in a business environment where credit terms are extended, either which way, you will have this scenario. Unless the commercial banks or somebody else can offer something in the market, risk-free, unsecured, no red tape, no contractual obligations, which is also why I like Payment Accelerator, because there are no contractual obligations for 12 months or 6 months. You can discount, offer, get your money, walk away. So the need will always be there.
Thanks for that. A lot of people out there wondering what exactly would be required from their company and what the process is like to actually implement Payment Accelerator. Maybe it's a good way to bring Ryan back into the conversation. Ryan, from your experience, what was really required from your company in terms of resources, time, and so on, in order to get Payment Accelerator set up and operational?
Yeah, so we run. I guess it would vary from company to company, but it was really just the integration component. So there was legal sign-off, which was just a couple of hours with our legal team, and then the internal development team sort of ran the project in conjunction with Daniel and his team, and we used a SAP consultant, I think, for 3 or 4 hours. To do the physical integration.
Okay, so it's not an onerous process from a buyer perspective, really.
No, not at all.
Okay,
not at all.
That's great to know. I mean, Daniel's always told me that.
Yeah, there's APIs in place, and I think they've integrated into a number of the ERPs, so it makes it's quite easy.
Fantastic. Yeah, a bit of a buyer's perspective on that.
So Ryan, the integration process, our CTO he's got many years of experience, and he's been instrumental in one of the largest medical aid providers integration infrastructure with the different medical switches. If you're not familiar with that, all of the pharmacies, the doctors that you go through, all of those claims are submitted digitally through an electronic switching platform, and essentially he's developed the infrastructure, and he was on the team that built that integration. So he's got a wealth of experience in integrating very diverse systems, and we built a number of tools to speed up that process. So typically when someone says to you, integrate with me, they say, these are my API, and if you're not technically inclined, just think an API is basically a number of commands that you must execute in a specific format. You make a request like this, but there's a lot of back-end logic that is taken for granted. When do you call an API? What frequency? What data do you submit? And so what we've done is we've developed tools that take all of that integration logic and remove the buyer's requirements to develop it. So we just go in, we have a consultation with the different stakeholders, ensure that the information that we see is valid at the point that we want to extract it, and then our tool will extract the information, format it correctly, and then push it through to the platform itself. And I just want to say, once again, there is no point in which a transaction can be manually loaded onto the system. It's literally by design. Everything has to come through integration.
So, I mean, I guess from a buyer's perspective, they've got resources, they've got CIOs and people that can work with you. What about rolling it out to suppliers? What's the process like to actually get the suppliers onboarded, and what kind of support can be provided to companies to get their suppliers onto the system?
Yeah, so we do the rollout with the buyer themselves. No one is going to just receive an email saying, get your invoices funded from an unknown party. everyone's going to be skeptical. So typically there's a campaign and there's effectively a process where we educate the suppliers. That's normally kicked off by the financial manager or the head of debtors in that scenario, who would send out an email to the vendors and say, that this is an opportunity available to them. We can offer them webinars in a similar format to take the suppliers through it. We have had instances where we'd be having a workshop and invite the suppliers. With City Logistics, our team actually was on hand to sit with their financial manager and the individual suppliers as they had queries and go through it. A lot of the SMEs who don't have any knowledge need to be educated, so we assist in that process. But the actual registration process is, it's click a link, fill in your company information, upload some documents. I don't want to try and present it as anything more than that. The main key of the onboarding process is education and showing the value to the SMEs, and we assist all the way through.
Awesome.
Maybe if I can come in here, Ryan. Sorry to interrupt you. Yeah, I think the advantage, one of the advantages, you asked about sort of the buyer benefits earlier, and one of the advantages on the supplier onboarding is that my experience with normal sort of reverse factoring arrangements where the financier is approaching the buyer is that there's sort of a limited number of suppliers that are that sort of fall within the criteria of what the financier wants to fund. In the instance of Payment Accelerator, as the buyer, you're sitting with Payment Accelerator and you're kind of identifying the suppliers that need the funding rather than the suppliers that the financier wants to fund. And that's quite an important distinction, because I think that's what gives Payment Accelerator the reach into the SME type market, where the typical reverse factoring actually only affects the large suppliers often.
Great insight. Amazingly, we've run completely out of time. I was tempted, Daniel, to have you do a live demo for us. I know it's a schoolboy error to try and do a live demo on something like this, and maybe we've been saved by the bell, and unfortunately I've run out of time, so we're not going to get around to that. Any final closing comments from any of you guys?
Look, I think we've captured the sentiment of everything. Ultimately, the key stakeholder in this process is the buyer. They're the large corporate funders. The funders have capital. They want to fund good debt, although this technically isn't debt, but funders want to extend capital in a safe manner. And what we really need is buyers to come to the party, just hear us out, look at the opportunities, and then consider the social impact. It's not necessarily always about the bottom line. In terms of the bottom line, you can certainly get value, but let's also look at the long-term social benefits of these sorts of products.
Fantastic, thanks. And I think that's a great point to end on. Ultimately, we're doing this so that we can improve the sustainability of these SMEs. And I do think, given the current context, it is a case of all hands on deck and everybody sort of doing whatever they can to keep as many SMEs sustainable as possible and to give them as many tools as possible to help them on their journey. So on that note, Daniel, Dion, Ryan, thank you very much for your insights and for joining us this morning and for sharing your perspectives. Also to the patent holder, Neville Kadachi. Thanks, Neville, for everything that you do and for really birthing the system. And then finally to all the attendees and for everyone who stayed on the session throughout, thank you very much for joining us this morning. We really look forward to engaging you post this. Please bear in mind the recording is available and the Payment Accelerator team is on standby to start engaging and to start getting this implemented. So on that note, nothing left to do but wish you all a great day ahead. Stay safe, and we look forward to engaging you at the next webinar.